Good afternoon to all the attendees. On behalf of MDAE, can you hear me?
Yes.
Yeah. On behalf of MDAE, I extend a very warm welcome to Mr. Dharmakirti Joshi for being with us this evening in spite of his busy schedule. Mr. Dharmakirti Joshi is a chief economist at CRISIL. He heads the economic research at CRISIL and has experience of macroeconomic analysis for a very, very long time. After his master's in economics, he attended a program on macroeconomic policy and management at Harvard University. He was a visiting scholar to Economic Research Unit of University of Pennsylvania. He worked as a member of the working group of savings for the 12th five-year plan. He is a member of the working group on the revision of wholesale price index of Government of India. He is regularly invited for consultation by RBI and the Prime Minister's Advisory Board. He regularly writes for leading newspapers and electronic media, and is also the member of the academic board of MDAE. So we are very delighted to have you with us. And I'm sure your insights, students are looking forward to listen, and me too, because I think even if you may be a teacher, but still you are a student. I'm sure I will also get to learn a lot from you. So looking forward, over to you.
Thank you very much. It's indeed a pleasure to be here and talking to students. And thanks very much for that generous introduction. So what I'm going to do over the next 30 minutes or maybe less than that is take you through the presentation is titled Contours of Recovery. That gives me flexibility to focus on, there are several contours of recovery. So my focus today is largely on inflation, although I'll lay an economic backdrop to why this is happening and what the central bank is doing and why it is doing so. So basically, I think the number one problem is inflation, and I'm going to focus more on that in today's presentation. So let me upload my so I need to be given the sharing options. I think I have them. Yeah, here is the. Is the presentation visible? Is it visible?
Yes.
And am I audible, clear?
Absolutely, yes.
Okay, great. So as I said, I think my focus today is on how the economy is coming out of the pandemic, and particularly on how the inflation is developing and why I think the central bank is doing what it is doing. Now, a couple of key messages before I launch into the details of the presentations. I think what happened over a course of last few months was that the risks which were largely coming from COVID, they have shifted very, very quickly towards geopolitics, which I think has resulted in high crude prices. And also, I think what we are witnessing is interest rate increases, particularly from the advanced country central banks, also from emerging market central banks. So clearly, there is a tilt in the risk away from pandemic. Pandemic is not over as yet, but if you look at the news today, I think it's very obvious that the other things have taken center stage now. So what does it mean? It means for the global economy, which was recovering from the pandemic, it means lower growth and higher inflation. For instance, my parent company, S&P Global, recently revised the growth outlook for the world down by about 70 basis points or 0.7 percentage points to 3.4%. And the inflation forecast was raised to 5.1% for the world as a whole, which is about 2.1 percentage points higher than what was predicted earlier. So clearly, the growth, inflation dynamics is worsening. I mean, so for India, we have a growth projection of 7.8%. Currently, the growth estimates for India vary from 7% to 8.5%. That's a pretty broad range. The central bank recently cut the growth to 7.2%. But we are yet to revise our outlook. Our growth is premised on crude oil staying at close to $85 to $90 a barrel. RBI has assumed $100 a barrel, so that's one of the reasons why I think their growth projections are lower. Now, this recovery in growth depends on a couple of things. I think it hinges on whether the infrastructure investment that the government intends to do, I think whether they come through or not, whether the private sector starts investing or not. Because I think right now, what we are seeing is that private consumption is quite weak in India. It is about 55% of GDP. It's not, it's one of the weak links in the overall growth story. And higher inflation that we are now beginning to witness, I think is going to be harmful for private consumption again. So the growth story is very uncertain to right now. Now, what do these developments also result in is the macroeconomic policy, which is, I'll very briefly divide them into the fiscal policy and the monetary policy. I think it reduces the space for monetary policy or fiscal policy to support the economy. The inflation going up means the central bank will raise rates. I think they haven't raised rates, but they have clearly signaled the tightening. What the global crisis, which is playing out after the Ukraine-Russia war started, I think is also crimping the fiscal space. And I'll try to explain very briefly what I mean by that. The government's ability to do what it intended to do has got reduced. Now, I think this is a very quickly the snapshot of GDP growth. I think after the dip of 6.6%, we rebounded to 8.9%. And this year, as I said earlier, our outlook was that we'll grow at 7.8%, and the risks to this outlook are tilted downwards. So I'm going to revise it, I think, in the next couple of weeks with more information being available. The second point I wanted to make was that what you see on the right-hand side chart is the components of GDP, how much they are above the pre-pandemic level. So pre-pandemic level for us is 2019-20. The trade has done well, exports, imports, I think they are all much above the pre-pandemic levels, so they have recovered well. The government was spending, so government final consumption expenditure, as it is called, I think that is also about 8.6% higher than 2019-20 levels. So this is 21-22 data. But moment you move to other components of GDP, which is the gross capital formation or investment, that is only about 2.6% higher than what it was in 2019-20. And private consumption, which is about 55 to 57% of GDP, it varies in that range, that is growing slower than the overall GDP, and it is only 1.2% higher than. So this is the point I wanted to highlight, that the private consumption is weak in India, and I think we can talk about it. Please feel free to ask questions, because as I said, my focus is more on inflation, so I will very gradually move towards that. The other thing I want to highlight is, which is reality now, seems to be, if you look at there are two charts here. I think what you see on the left-hand side is it plots the peaks of COVID along with the mobility. I think now after the COVID started, Google started providing a lot of data on how people are moving. And mobility data is in some sense a proxy for how the economy is behaving. And what you see here is that the first wave, which started sometimes in March, April of 2020, that wasn't very virulent, or it didn't lead to too many deaths, so to say. But the mobility came down very sharply. It came down by almost 86%. Now that is a very sharp decline, and this was largely because of fear factor. We didn't know what we were encountering, so everybody wanted to be cautious. But as we moved ahead, I think what we all found that even with a very virulent second wave, which played out in the April-May period of 21, the mobility did not fall that much. Mobility fell only 66%. And in the third wave, which we just passed by this year, the mobility was only 15% below the pre-pandemic level. And right now, I think as there are talks of a fourth wave also coming in at any time, the mobility is at all-time high. So you gradually, I think the fear factor is declining and you're learning to live with the virus. So what that means is that the parts of the economy which were hit because of fear factor, the services which are the first one to be closed, I think they will rebound. Now, if you look at contact-based services, they are still about 11% below the pre-pandemic level. So there will be a sharp rebound in contact-based services if the pandemic proceeds the way it is into the endemic stage. Other thing to notice is that we are doing well on vaccinations. Our vaccination rates have crossed the global vaccination, and that actually makes it easier for the contact-based services to rebound. So I think that's on the COVID side and on the mobility side. Now I want to shift to the policy. I'll briefly speak about the fiscal policy, what role it is supposed to play and why it will not be able to play that role. So here, I think in this chart, so fiscal deficit in last fiscal year, which is 21-22, it was estimated at 6.9%. Now, government intends to bring it down to 6.4% in 2022-23. So how does it intend to bring it down? It wants to reduce the emergency spending that was initiated due to the pandemic, which was giving a huge amount of food subsidies, cutting down on fuel subsidies. So all the support they thought, or Narega spending, which is employment generation, they would be able to reduce it. So normalization of the pre-pandemic spend was one of the major factors which would have led to decline in the deficit by only about from 6.9 to 6.4. It's not a big decline because government did not want to hurry into cutting the deficits too much, because then they needed fiscal space. They know that there is need to support the economy. The second thing they did was they reshuffled the expenditure, as I was pointing out. So if you see here, the spends on infrastructure, roads, highways, etc., were expected to go up, whereas the spends on pandemic-related emergency spending, subsidies were supposed to come down. But this fiscal year has barely started, and we are already seeing the food subsidy bill of the government 80,000 crore more than what was budgeted, because they have extended the food program. Second, I think the fertilizer subsidy is also expected to rise extremely sharply. So what the point I'm trying to make is that the way government was planning to control the pre-pandemic spends, I think it's not going to play out that way. So if they want to keep the deficit low, then they will have to cut spending elsewhere, or I think the deficit will go up. So this is what I meant by crimping of the space to do what you want to do. And I think this is how the fiscal policy is playing out. So now let me switch gears towards inflation. I think that is the number one theme right now. I'm sure you all know that we have an inflation targeting framework in India, inflation targeting regime, where the central bank has to keep the inflation in the 2 to 6% band. And the green line that you see is the 2% band, and the red one is the 6% band. And now this is a very, very, very wide corridor, so to say. So what they do is and over the medium run, their policy should be taking inflation towards the midpoint of the range, which is 4%. Now, if you look at this data, This is essentially from 2019 onwards. I think we've stayed above the 6% mark for quite some time. I mean, it was tolerable during the pandemic time because that was an emergency situation. But now I think it's again, the data came out yesterday, inflation has crossed 6% and is at close to 7% for the month of March. So clearly inflation is rising. And I think RBI, now what it did was, RBI in the month of February forecasted that inflation for 22-23 will be at 4.5%. But actually, they saw that that forecast was too optimistic, and within 2 months they increased the forecast from 4.5 to 5.7%, and now the risks to this 5.7% are tilted only upwards. So so this is the point I wanted to make, that if inflation stays above 6%, which it has already stayed in the last quarter of 21-22, in the first quarter of this year, which will be April to June, RBI has already forecasted 6.3%. So 2 quarters of over 6%. And if the third quarter is also over 6%, then central bank is answerable to the parliament. They'll have to give reasons why this has happened. So that is, I think, the fingers crossed on where it's going to land eventually. Now, the other point I wanted to make was that the inflation is not only rising, it's also becoming more broad-based. So let me try to explain what I mean by that. If I look at the 2019-20 data here, the overall inflation was 4.8%. Food was 6%. Fuel was very low. Crude oil was very low at that juncture, and the core inflation was close to 4%. In the pandemic year, food inflation shot up to 7.3%. Fuel marginally increased, but the core inflation started rising. So that yielded an overall inflation of 6.2%. Now, after 2021, we had 21-22, which the year that just closed. There, what we find is that fuel inflation shot up to 11.3%, core inflation rose further to 6%, and the only savior was food. Food inflation was at 4.2%. Now, I think in the year that is coming, or year that has just started, 22-23, there is an upside risk to food inflation. It's going to go up. Fuel inflation, even if it stays at 10%, that is very high. Core inflation is going to rise further. So that's going to lead to an overall push in inflation. So again, instead of 4.5% inflation in 22-23, which RBI visualized in February, you're going to end up with something close to 6%. Now, so this scenario is worrisome. There's absolutely no doubt about it, but it's not as worrisome as it was in the years 2012 to 2014. Many of you may not remember, but the oil was at $110 a barrel for 3 years. At that time, fuel inflation was high. The food inflation was also extremely high. It was close to 10% during that period. And core inflation was also at around 8.6%. So you got an average inflation of close to 9.2% between 2012 to 2014. Now, the scenario that is playing out right now, you have similar levels of fuel inflation, but the food and the core inflation are at lower level. But I think the risk is that both are beginning to rise. So I think it will have to be watched very closely as to where I think inflation goes. And I'm sure the analysts as well as the central bank have their eyes peeled for trends in inflation. Now, let me try to explain what's going on in the food segment. I mean, why is there risk in food items? If you see, this is the chart here shows the trajectory of food inflation. And if I come to the latest part, which is from the last data point is close to 8%, which data that just came out yesterday. So inflation, the point is that inflation is moving up. The prices of edible oils have risen. They were already very high. And now I think with the Russia-Ukraine conflict, because of the sunflower issue, sunflower oil typically comes from Ukraine, and I think that has been completely the crop is not there. I mean, and it's not getting planted. So clearly there is a deficiency. And India is a large importer of edible oils. I think more than 60% of our requirement is imported. So clearly there is a pressure on edible oils. Second thing that is happening is is that the cost of producing grains or any agriculture output is rising. The fertilizer prices are very closely linked to the crude oil prices. The naphtha is the feedstock for fertilizers, ammonia. So rising fertilizer prices means that either fertilizer subsidy goes up or cost of production for farmers goes up. And then I think there is another, I've written rising, but I have not mentioned, but this, what I had in mind was the pesticides. Again, I think they have a petroleum component in them. I think pesticide prices have risen very sharply. So that's an important input. Irrigation, cost of irrigating unit of land has gone up because diesel prices have moved up. And then finally, the feed for animal, the fodder, I think the RBI governor specifically pointed this out. That has also increased very, very sharply. So if the cost of production of agriculture is rising, it will reflect in the output prices, because government will also be forced to provide higher minimum support prices to the farmers in the crops like wheat, rice, etc., etc. And then finally, food inflation depends also on how much output is produced, and that is still linked to how the monsoons play out. They are expected to be normal, but we all know that monsoons are a wild card for India, so they need to. You can't be sure until you see them. And I was talking about the input costs. So I have plotted in this, I've constructed a brief index of farm input costs. And this is shown by the black line. And you can see that how sharply the farm input costs have risen since April 21. So in the last 1 year, they have been continuously rising, and there is further pressure, I think, on them to go up. And so these are at the wholesale level, obviously. So clearly, I think this is going to get reflected in minimum support prices and higher prices for grains as well. So there is a pressure on food inflation. It's not as high as it was during 2012-14, but it is rising. So it's a key monitorable. Then let's talk about the other component of inflation, which is core inflation. Core is computed by taking the most volatile components of inflation out. So core, if you take fuel out, if you take food out, food is also idiosyncratic, if I may use that term, a very volatile part of consumer prices. So if you see on the trend in the core inflation, I think it's been on the rise since 2019. I mean, it's moving up, and there is a pressure for it to go up further. So core inflation typically measures demand. And I pointed out earlier that the demand is weak, the private consumption demand is weak. So why is core inflation rising? So I think the reason for that is the supply shocks. They are not one time. They are becoming persistent. I mean, the commodity prices were rising in 21. Now, I think in 22, after the Ukraine war, they're rising even faster. So clearly, there is the producers are facing very high costs, and eventually they pass it on. Now, this pass-through is not happening uniformly. It is, I think, for items which are I can say that luxury consumption items, there the pass-through is much faster. But pass-through is also there for things like biscuits and so on, where I think typically what the companies do is they reduce the size of the packet. I mean, so they'll instead of 50 grams worth of about 50 gram biscuit, they will have only 45 grams. So as a first step, they try to do it through that way. I mean, to manage the costs. But that is not, since that is not enough, so now they've started raising prices as well. So the point is that if the cost rise too much, then the producers have very little option but to pass it on to the end consumer. Otherwise, the hit to their margins, hit to their profits is extremely large. So we are in that situation where in some segments, like let's say the paint segment, which is if you want to whitewash your house today, the cost would be at least 15% more than what it was last year. The reason is the paint companies, real estate is doing somewhat better, so paint companies are very quickly passing on the increased input costs to the end consumer. So clearly, so this, despite overall weak demand, you are seeing pressure to pass on the costs, and I think this companies do as much as they can to the extent they can. Because they also need to protect their margins. So now I think just to give you a perspective on how fast the input costs have risen. So wholesale price index means prices at the wholesale level. So if you see the data, I have between 91 to 95, the average inflation in wholesale measured through wholesale indices was 11%. After 95, I think it has averaged around 5 to 6%. I think that is the broad average. In the last 5-6 years, suddenly there was a collapse of commodity prices, and that led to inflation only being at 1.4% per year between 2016 and 2020. In FY21 also, which I showed you the data earlier, that the fuel inflation was not that high. It was only 1.3%. Now look at the year that just went by. It is 12.7% and is only rising right now. So clearly, I think there is a unusually high increase in the cost of inputs. Wholesale prices reflect that. If I take the agriculture out of this and just focus on the non-food part, that is rising at 15%. So clearly, the point I wanted to bring to your notice was that input costs are rising extremely sharply right now, and this is something which has not happened in last 20 years or so. So this is happening for the first time. So that pressure is very much there. And I think there are various other ways of measuring input costs. I think all of them do point that this is an unusual increase. Now, so why are input costs rising? I mean, one, of course, is crude, but there are many other commodities where prices are set by imports. Your currency is weakening. So if you look at this chart, I have plotted import UVI. So UVI stands for Unit Value Index. So this is a data which I think the Ministry of Commerce works out. This measures at what rate the prices of imports are rising. So there is this is often used. This is a little lag, but I think it's very clearly showing you that there is a very strong correlation between the imported costs and of many commodities and the wholesale price index. They almost move together. And in the last 1 year or so, what we are seeing is the import UVI is rising extremely fast. It is much higher. I think it's the inflation in imported imports is more than 30%. I mean, whereas the wholesale price inflation is 12-13%. So there is a very strong imported component here. I mean, which is influencing the wholesale, which is increasing the input cost for the producers. Now, so what did the Ukraine crisis do? I think just in a month, I mean, between March and February, the crude prices rose 20%, coal prices rose 44%, natural gas prices rose 6.1%, wheat prices rose 24%, corn prices 14%, edible oil 12%. This is over the previous month, by the way. Fertilizer prices 26%, aluminum, iron ore, what have you. I mean, everything increased, and that has some weight. These commodities have weight in WPI, in CPI. So they are, I think, the imported component of inflation is putting pressure on prices. Then I think comes your services. So far, we have seen service inflation is lower than, particularly in contact-based services, is lower than the goods inflation. Now what we are going to see in the next couple of months is that service inflation is going to rise. One, because the input cost for services have risen very sharply. This is pointed out by the PMI data that S&P Global, which is my parent company, publishes. And and it's and contact-based services, as I said earlier, are also bound to move up much faster because we are now getting some control over the pandemic. So as a result, I think the services inflation will also contribute to inflation, which it was below goods inflation. Now it's going to, I think I'm moving towards the end. So here I think I have, so how do you, it's a very important task for analysts, for RBI to forecast inflation ahead. So I'm just going to look at how they have performed in the last couple of years. So the dark brown line that you see is the forecast by professional forecasters like me. So RBI collects data from a number of agencies which forecast inflation. And then, so this is the forecast that is made at the beginning of the year. As the time passes, you get closer to the reality, but how much can you accurately perceive the direction of inflation is what I'm trying to capture here. So in fiscal 18, the inflation came in at 3.6%. The professional forecasters were saying 4.3%. The RBI was saying 3.4%. So it came in somewhere in between. In the next year, I think you see professional forecasters making a projection lower than RBI. The actual inflation came in somewhere actually, it came much lower than what RBI was saying and what professional forecaster was saying. After fiscal 20 onwards, we see that in 2019-20, both professional forecasters and RBI were talking about inflation. They were close to each other, 3.5 to 3.3, and inflation came in at 4.8%. In the next year, again, I think RBI did not make any projection because of the pandemic, but professional forecasters, they have to earn a living, so they had to come out with a number, and which was 4.8%, but actual inflation was 6.2%. In the year that just went by, in the beginning of the year, RBI said inflation will be 5%. The professional forecaster said 6.2%, but actual inflation came in at 5.4%. Now, as we stand here, and the policy that was announced and the professional forecaster survey that was released, I think both of them are talking about 5.6 and 5.7%, very close to each other. And my sense is what happened during the fiscal 20, where I think both were close, but actual inflation turned out to be much higher than what RBI and forecasters were saying. I think that kind of scenario looks quite plausible at this juncture. Now, I think so. Here, very quickly, I think I'm taking more time, so I'll very quickly try to wind it up. The point I'm trying to make here is that the monetary policy or the India's interest rate direction is also shaped to some extent by what happens in systemically important central banks like the US Fed, for instance. Now, this, I think, if I take you back to the global financial crisis of 2008, at that time, the Fed raised interest rates after 7 years of when they it took them 7 years of quantitative easing. 2008, they began the quantitative easing, and in 2015, they made the first rate increase. This time around, the crisis started in 2020. The tapering already started in 21. And now I think the first rate increase came in the month of March, and they are going to raise interest rates by 6 to 7 times at least. So the point here is that after the global financial crisis, the increase in global interest rates or the Fed interest rates was very gradual. Right now, I think the shock is much, much stronger. I mean, so that also puts extra pressure on the central bank. It's not a deciding factor, but it does influence. So where is RBI in all this? here, I think you would have heard the term real interest rate, which is interest rate minus the inflation rate. And the real interest rate is computed by, for instance, for FY13, 9.9 is the CPI, 7.9 was the repo rate. So the real interest rate turned out to be negative, right? After inflation targeting was adopted in 2015-16, what we find is that the repo rate or the RBI's policy rate is always higher than the inflation rate, which means the real interest rates were high, which means the policy was generally tight, and that coincided with a period of low inflation as well. Now, after the COVID crisis started, we are again back to the regime where real interest rates became negative, which means that the inflation was higher than the interest rate. And even if RBI raises interest rates by 50 to 75 basis point in the current fiscal year, even then interest rates will be negative. So the point I'm trying to make is that the monetary policy is still easy, I mean, despite rising inflation. So RBI will have to hurry up now. So what did it do in the last policy? I think it was a good move because you saw very high inflation immediately after the policy. So RBI is not tolerant to supply side supply shock inflation anymore. Typically, central banks ignore supply inflation. I think in US also, whenever crude prices went up, the Fed just looked through it and the prices stabilized very quickly. But this time is different. I mean, and the shocks are very persistent and coming from many directions. So that is why RBI raised its inflation forecast to 5.7% and reduced the growth forecast to 7.2%, because in just 2 months, I think the outlook on oil completely changed. I mean, it was $80 a barrel, now it became $100 a barrel. And then there are, as I said, there are pressures on food inflation and other things. So India's inflation is not because of demand, I mean, so much. There is still slack in the system. It is largely because of persistent supply shocks and the need to pass it on to the end consumer. So what RBI has done right now, very briefly, is that they have said that they will suck out liquidity from the system. So how do you suck out liquidity? You offer bank incentive to park money with them. And what RBI has done is they introduced something called this SDF, which is the rate at which the bank, which is the interest rate which banks get when they park their money with the RBI. So they raised it by 40 basis points. So which is a signal to the banks that if you don't have anything else to do with the liquidity that you have, excess liquidity, please bring it, keep with us, and you will get a higher interest rate right now. So that's one. It's already sucking out liquidity over the last couple of months, but it wanted to give a very potent signal. So I think to close, the inflation is the biggest problem, which is macroeconomic problem, which is staring at us right now. Central bank has not formally raised interest rates, but I think it has done several things which will lead to higher interest rates going ahead, and it will also raise interest rates in the coming policies. Already because of this signal, the 10-year government bond, which is the risk-free rate in the economy, it has already gone up by about 20 basis points in the last 2-3 sessions. So there is already a pressure building up on interest rates, which was already building up. It's further gone up. So I think the message is fasten your seat belts. The days of easy monetary policy are over. The cost of borrowing is certainly going to rise. So let me close here. And I think I've taken a little more time than I should have, but I'll be happy to answer your questions. So let me stop sharing. Yeah. Hello.
Hi. Very interesting presentation. Absolutely. The question should come in the chat box.
Okay, so let me. Yeah, I don't have questions right now. I have some greetings.
I'm sure they'll come.
Yes, I think the participants have raised hands. So please, please go ahead.
Yeah, good evening, sir.
Good
And
evening.
thank you so much, sir, for such an insightful session. So I have a question like few days ago, as we have mentioned already, like in the bi-monthly monetary policy by
Mhm.
RBI, it has announced a new tool to pump out excess liquidity, which is standing deposit facility, where it
Yeah,
allows like to absorb liquidity from commercial banks without giving government securities in return to the banks,
that's
which
right.
happens in the reverse repo rate case. So, sir, I have a question like how will it impact state of inflation directly, as well as consumer sentiments and purchasing power per se?
Sure. So I think it's a signal, and the signal is that interest rates are going to rise. As I pointed out, the risk-free rate in the economy is what is the rate at which the government bonds are offered, and the GSECs, as they are called, that has already risen. So if the risk-free rate rises, the other rates are going ahead only going to rise. And so this was a signal towards tightening, and the markets very quickly factor that in. The banks have not started raising interest rates right now. I think as the liquidity gets sucked out, what will happen is the operative rate will be the repo rate. And then I think when RBI raises repo rate, the banks will also transmit to the rest of the economy. So interest rate tightening has happened in the risk-free environment, which is the government bond. It is going to transmit to the rest of the economy over a period of time, gradually. Already, I think the deposit rates, etc., are beginning to move up. I mean, and we'll see more of that going ahead. Now, in the inflation, the only way RBI can control inflation is by slowing down the economy. I mean, there's no other way, because they can't bring down the fuel prices, they can't bring down the food inflation. They can only control the second round effects. So as a result, I think the economy, it will temper the economy down further. Inflation in itself is extremely bad for private consumption, which is still quite weak. And so I think it's going to make recovery difficult. I mean, but again, I think consumption is going to fall, not for everyone. There is a K-shaped recovery happening. The inflation is hitting the lower income classes more than it is hitting the upper income strata, who have gained, I think, during the pandemic. They have become richer. So it's going to create further dichotomy in the system by hitting the poor more. So that's how it's going to play out.
So, sir, we can say that it can adversely affect the stock markets also if the interest rate are going to rise in the future.
Obviously, I think if the economy right now, I'm not an expert on stock markets, but the stock markets seem to be completely divorced from the economic realities, and maybe they are too forward-looking. But clearly, I think once the liquidity starts getting sucked out, the foreign capital inflow will also reduce. So all these things are not very healthy for equity markets. Now, there's another question on if the Ukraine war wasn't there, we would be in a better state with lower inflation. Yes, we would be in a better state with lower inflation, but not as low inflation as RBI was predicting at 4.5%. We were still, I think, even without Ukraine war, you would have ended with up with inflation close to 5.4, 5.5%, because the oil prices were already up, I mean, even without the war. Yeah, what the war has done is it has injected uncertainty. It has also created an upside to inflation. So all the ills that you could perceive, I think, are playing out for the economy through the Ukraine war. Yeah, but our recovery would have been stronger without the Ukraine. Inflation scenario would not, as I said, it won't have been as healthy as RBI was perceiving, but it would have been the scare won't have been there, I mean, so to say. And as I showed you, the imported component has a larger, very significant role to play in what is happening. Then I think there's a question. There's another hand up. You want to ask this question, please?
Yeah, thank you, sir. So my question is, in the beginning of your presentation, you had mentioned that the capital formation rate in India is quite low.
Yes.
Now, since we are expecting monetary policy in India to tighten as a response to higher inflation, do you think that might lead to a situation like a stagflation in the near future?
Well, I think, see, stagflation term means that stagnation. I think India doesn't stagnate. I mean, it will still grow. So I think you can say that you are moving towards stagflation, but I haven't seen a stagflationary situation play out, except maybe in 2021 when growth was minus 6.6% and inflation was 6.2%. But when this term is overused, we will not get stagflation, but yes, we will be moving towards worsening of growth inflation mix, which means higher inflation, lower growth.
Okay, thank you, sir.
Yeah, and another question is I think it's what will happen to the public borrowings of the government of India as if interest rate goes up in future? How is the public will participate in the bond market due to shortage of money and then pay? See, I think what happens is that when government has to raise money from the market, the borrowings have gone up very significantly. Just to give you an example, borrowings in 22-23 are 2 times what they were in 2019-20. So there's a massive supply of government bonds. And if there is not enough demand for them, then I think government has to offer even higher interest rates on its bonds. So which means that the yields will firm up. So there is and we are already seeing that play out. That is why government is very cautious. They don't want to exceed their borrowing requirements, which are already very high. And it will mean that government's debt servicing costs will go up. It will also mean that government's fiscal leverage will come down because they'll have to spend more on interest payment and debt servicing. So it is negative for growth, but it's not a dominant factor for growth. I mean, at least for 22-23. How badly will the Ukraine war affect food inflation? Well, Ukraine is famous for wheat. Ukraine and Russia. It's also Ukraine used to be the grain bowl of USSR at some point in time. It also produces sunflower oil, which in quite significant quantum. So now all these two are clearly exerting prices on. We've seen edible oil inflation go up. We have seen wheat inflation go up. I showed you the data. And then I think the cost of producing agriculture for the rest of the world is going to rise. So it's very adverse for food inflation. What is your projection about the expectation of first interest rate hike in August? Well, I think the first interest rate hike will happen in June itself. RBI will change the stance to neutral, and because now I think inflation pressure is, as I said, is getting broad-based. So you can't ignore it, I mean, at this juncture. Is the high debt to GDP ratio a warning sign? Well, I think India's debt to GDP ratio is high. I think we have to be careful because what happens is your sovereign ratings, which is done by companies like S&P and Moody's, it depends on many factors, and the indebtedness is also one of them. And India's indebtedness in the group of countries which are rated just investment grade is the highest. So it's the most vulnerable from the debt perspective. So we need to be careful about that. Dr. Bhagyashree, I think you had a question, or your hand is raised.
No, I don't know how it has come.
No, that's okay.
Yeah, but just I would like to ask one question. And you said the consumption levels have not increased in India. So is it because of the income inequalities, or it's because the migrant labor has not returned yet and we have not gone back to pre-pandemic situation? Can you
yeah, sure. I think migrant labor has returned, but not completely. I think they're still parked in rural areas. And my sense is that if contact-based services pick up, the demand for the migrant labor will rise. Your rural economy, incidentally, is not doing that well, so they will be incentivized to move towards the cities. So some of that will get corrected, but the weakness of consumption is largely because of the K-shaped recovery. I think wherever you see, I mean, if you look at motorcycle sales, they are doing extremely badly. But if you split motorcycles into high value motorcycles and low value motorcycles, it's the low value motorcycles that are doing badly. The high value ones, the premium ones are still doing better. The premium cars are doing better than the ordinary cars. So everywhere this income inequality is showing up in various ways. There are several ways to look at it, and all of them do point out that small firm is hurt more than the large firm. So I think there is a very clear K-shaped thing that has happened because of it was anyway there. I think the pandemic has just given it a booster shot.
Thank you.
Yeah, and what can be done other than increase in interest rate for controlling inflation? Well, I think this is a supply side inflation, and supply side inflation is best controlled through fiscal policy. So for that, government will have to reduce the duties on oil, on imports, etc., etc. But since the fiscal pressures are building, so and there is a trade-off. I mean, if you reduce the duties, your fiscal deficit goes up. So economics is full of trade-offs, and all the ugly trade-offs have become very active at this juncture. I mean, if you raise interest rates, well, you control second round effects of supply shocks, but at the same time, you also slow down the economy, and you also raise the cost of debt for the government. So there is, I think, all the trade-offs will have to be neatly balanced, I think, going ahead. These are challenging times. I mean. If inflation is going to rise and private consumption is yet to pick up, how should we solve this problem? Well, there is no solution to this problem. I mean, the only support for private consumption will come from the return of contact-based services. So if you look at the supply side components of GDP, the contact-based services are still 11% below 2019-20 levels. So if pandemic is becoming endemic, then we will see these contact-based services shoot up. And if you look around right now, if you want to book a place for vacation or take a flight, I think the prices have really shot through the roof. I mean, because of crude oil increases, also because I think the demand has risen. It's extremely difficult to get a hotel right now. So these are all contact-based services, and they have, as I said, they will do well as long as the COVID is under control. So if these pick up, and these are largely in urban areas, 2/3 of the contact-based services are in urban areas. So if these pick up, they will reduce some amount of income inequality, because the people who've gone back to the rural, who used to work in urban areas, will be incentivized to come back. This will also mean that the wages of people working in these contact-based services who had to take salary cuts, etc., will be moved up. So there is, I think, but this is not going to correct the problem, I think. So that is, why do you think government announced 80,000 crore worth of free food grain? Again, they extended it. It's because they realize that there is a part of the economy which is suffering right now. We know that government has mooted the idea of fiscal council. Well, fiscal council, council reason being forecast being we're optimistic, or do you think that coming fiscal council going to help? Well, there is no fiscal council as of now. This government, as far as I have looked at the budgets, is generally conservative in nature. I think they don't overproject, and at least this budget is extremely conservative. I'm 100% sure that the tax collections are going to be more, even with the slightly slower growth, are going to be more than what they have budgeted. This happened in 21-22. This is again going to play out in 22-23 also, because what has happened is the larger corporates, the rich people, they have consolidated their position, whereas the poor have suffered. Who pays the taxes? It's the formal sector. So that's why government's tax and formal sector is going to continue to do much better relative to the informal segment. So the tax collections are still going to be healthy. So I don't think they are erring on the side of over projecting. I think, and the budget is now become more transparent also, because they're not hiding things That's one of the reasons why the deficit number looks bigger. So, but yeah, Fiscal Council has been a demand. It has not been announced as yet. I think it's just on paper. So I think that is probably I've covered almost all the questions that I can see in my screen.
And just one more thing, if you could throw some light on our neighboring country, Sri Lanka.
Sure.
Seeing a lot of problems, and so
yeah,
I think comparatively we are better off, we should say.
No, I think Sri Lanka was one of the success stories of this region. I mean, its per capita income higher than India, the quality of life better. What I think how the wrong policies can mess up, I think is Sri Lanka is a good example. So what has happened is a number of things, and one, I think, of course, it was war torn, so I think that obviously has an impact. Its manufacturing sector did not do that well, so its services are a larger part of the economy. 73% of the Sri Lankan economy is in services, which is IT, ITS, and also tourism. Now, tourism has been hit. Incidentally, you know, the maximum tourists to Sri Lanka are from India, followed by Russia. So obviously, I think so these are not the cause of the problem. The problem started when the government decided that they will only promote organic farming. They banned the import of fertilizers. So what happens if a country is using fertilizers, chemical fertilizers for 40 years, 50 years, and suddenly it is supposed to go organic? The yields will plummet. And this is exactly what happened. So they have to import a lot of stuff now, and they don't have money. Sri Lanka has already defaulted on its foreign debt, and it is looking for IMF to support it. So this is one. The second, I think, error they made was they cut the taxes across the board. And this was a populist move. Now, if you cut taxes, your tax collections will go down. So now they have to reverse that. They'll have to raise taxes going ahead. The currency has plummeted. I mean, so their key export is tea. Tea has not been impacted to that extent, but I think obviously some amount of impact because of this policy is that they have to revert. They've said that now you're free to use fertilizers if you want, but now they don't have money to import fertilizers. Their foreign exchange reserves are only $2 billion, which can only support a month of import. So in a very, and then on top of that, they have Chinese debt, which has to be paid. I mean, they are heavily dependent on that. China has already acquired one of their ports because they couldn't pay back the debt. So so it's a number of things coming together. I think it's a bad economics. I mean, and populist policy. So this is what bad economic policy can do to the country.
Is there any question, or I think we'll wind up?
Yeah, I think we can. It's 6 now, so I think.
Samriddhi?
Yes, ma'am. So, ma'am, I'm not able to start my video for some reason.
Go ahead.
So with this, we come to the end of this highly informative and insightful session. I would like to propose the vote of thanks before we conclude this meeting. First of all, I extend my profound and heartfelt gratitude towards our speaker, Mr. Dharmakirti Joshi, for making time and conducting this wonderful session. As students of economics, we all read about where the economy is heading, the potential geopolitical implications, and the upside and the downside risks entailed. The session was especially useful in making sense of all of it at a time when the most pressing issue is driving the recovery of after the pandemic. I'm sure we all benefited from your expertise in this field. I would also like to thank MBAE for organizing this session and all the students for their participation and patience. Thank you.
Thank you very much. It was a pleasure indeed. I hope it was useful to all. So
Absolutely. Thank you so much. Would love to invite you once again sometime little later if you find time for us.
No, sure. I think this is part of my work. I mean, I typically make 2-3 presentations every day. So
My God, yeah. But It was really very insightful. I mean, I'm sure students have benefited a lot because your hands-on experience, makes a lot of difference. We are more into theory and books, but what happens day to day, I mean, that those insights were very, very useful for us. Thank you.
I'm very happy to know that, and thank you very much for inviting me. And all have it's a long weekend coming, so have a good weekend.
Okay. Thanks.
Thank you.